Are you a first home buyer and unsure of where to put your money to get the biggest gains in 2024? The Fast 50 is a valuable resource for property investors looking to make informed decisions about their real estate investments. Be the first to get into the next investment hotspots and make your money work harder for you. Get your free copy of the report now by visiting smartpropertyinvestment.com.au.
This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Hi, g'day, how you going? Phil Tarrant, host of the Smart Property Investment Show. Hope you're well. We're here to talk again, as we do every couple of times a month, mortgages. No one really likes to talk about mortgages. There is sort of a necessary evil for many property investors who don't have cash money as to enable them to invest in property. So if you want to invest in property and you got to accept the fact that you probably need to borrow some money, or if you have cash, if you want to accelerate your ability to acquire assets, leverage, as in using debt to support portfolio growth, is something that you need to be comfortable with and understand. A lot of people just get obsessed with the idea of investing in property and start looking at suburbs and properties to buy, and they forget the very important component, which is access to finance. And it's now as relevant as what it ever has been, considering the fact that we've gone through all those interest rate rises over the last period of time. Bit of a pause this month. The mail coming from the major banks, and nothing's really changed, is that there's probably at least one more interest rate rise. I think that's what the Commonwealth Bank has come out with recently, saying that the other lenders vary on where they think is going to end. But the good news is that we're probably getting towards the top of the interest rate cycle. We have a new announcement. A Reserve Bank governor is going to be coming in. They're going to be changing the way in which they do their monthly cycle of interest rate reviews. The official cash rate is going to be less of them over the coming time. They're changing the way in which the governance of the bank works and how they make decisions around interest rates. Outside the scope of this, we've spoken about it on the Smart Property Investment Show. You can go and tune into it. But with less announcements, you would hope there's less chances for interest rates to go up. But on the other side, it will be an important time when interest rates do come down. It's just how long this period of stability will remain. Is it going to be 6 months? Is it going to be a year with the official cash rate at the point where it is, or is it going to move up and down? I can't see going up and down and up and down. I think it'll just go up. It'll flatten out and then it'll come down in time once the Reserve Bank has had the impact that it's wanted to try and curb inflation and take some of the heat out of the economy, which has certainly taken place. That said, a lot of Australians have a rude shock around interest rates, trying to come up with the extra dollars every single week, month and year in order to service their debt. A lot of people who entered the market or took on mortgages over the last couple of years probably did so with interest rates that started with a 2, some people even a 1. Now expect to see, if you're an owner-occupier, at least starting with a very high 5, and if you're an investor, it's going to be 6+. So that's reality of the market. Now, what that means, and you hear a lot about this at the moment, there is this cadre of people who are going to be coming off fixed rate products onto interest-only products over the coming period. It all sort of begins now. It's been underway and it'll probably pay out for the next sort of 9 months or so. That means that people who are on 2% rates are going to be moving on to 6% rates. And the other side of that is that people are coming off interest-only periods, which are usually 5 years, into principal and interest. So again, they're going to have to start paying the principal component. So it means that people are going to have to pay more money to service their debt. Paying principal, that's not a bad thing if it's an owner-occupier, getting outside the scope of this. But a lot of people are sitting there going, I'm stuck, I can't do anything. And you'll hear this term around mortgage prison. And that is, I can afford to pay for my mortgages now. It's hurting me and I've had to make some cuts and it's putting stress on the family and the family budget and all that sort of stuff. However, I can't refinance because I don't meet the serviceability requirements of the lenders. And that being APRA, who's the prudential regulator, many years ago said, we're going to get banks to look at the serviceability of borrowers at 3% over what the actual interest rate they get is. So in the current market, if you have a loan that is 6%, the bank will assess your serviceability on the basis that your loan is at 9%. That's in really simple terms. So the mortgage prison is the fact that people can't meet the serviceability requirements at 9%, and therefore they're stuck with the loan that they have because they can't move and get reassessed by another bank at 9% because they don't have the serviceability, and or the lender that they're with just go, no, I'm not going to give you a cut on your interest rate. Too bad. That's just the way it is. So whether or not you like that or not, that's completely your decision. But the banks are in the business of making money, and they will ensure that the interest rate that you pay is probably low enough that you stay with the bank, but high enough so they can make sure they can make as much money out of you as possible. That said, some stuff's changed over the last period of time. I want to have a chat about that today, which could help you not only with your owner-occupier mortgage and your current mortgages, but being a utility to continue to support you investing in property. Joining me in the studio from Finny Mortgages, finny.com.au, is Eva Loenzons. We're going to talk through some of these changes. Eva, how are you going? You well?
Yeah, good, thank you. Yeah, lots of change happening that might help people in mortgage jail. So I'm really keen to chat about that one.
Do you call it mortgage jail or mortgage prison? Do people call you up, go, I'm in mortgage prison, Eva? What can you do?
I don't know what you call it. Depends how long you're going to be in there for, I guess. And there's a lot. There's been a lot on occupier investors alike. Borrowing capacity has gone down by roughly 30% last year, or up to this point this year. So, a lot of people find themselves being told that they can't afford what they've got, even though they're making the repayment. They feel like they could actually afford more. They are being told it's not working because of the 3% buffer rate, which is on top of every other buffer the bank has. So, sometimes they might take 80% of your overtime, 80% of your rental, 70% of your bonus. There's a lot of buffers happening.
Yeah. And good luck trying to work with the bank on sorting all that out. And I imagine, Eva, you've got a lot of people who are just going, I can't deal directly with the bank anymore, because if you're a current customer of a major bank and you walk into a bank branch, they'll probably tell you to go and speak to someone on the phone. You speak to someone on the phone, they'll make it near on impossible to get those changes. So for those of you who don't have a relationship with a mortgage broker and you want to have a really smart look, an independent look at your mortgages, I highly suggest that you do speak to a mortgage broker. So is it a term people are using, mortgage prison or mortgage jail, or they just go, I'm stuck, the bank won't change?
It's a lot of I'm stuck, but I think it's it's out there now, this idea of mortgage jail or mortgage prison. It's in the media, and I think it's like a new thing about mortgages.
Yeah. All right. Well, let's try and help people get out of prison. We'll go to a quick break beforehand. Stay with us. Back in a moment.
Stop overpaying on your home loan. We understand that managing your finances can be overwhelming, especially as interest rates continue to rise. With access to 70+ lenders, our team of specialised brokers will find the best rates for your specific needs. Count on us to secure a lower rate swiftly, giving you the confidence you deserve. Book an appointment with one of our experts today to protect your financial well-being and secure your future. Call us now at 02 8866 2444 or visit our website at finny.com.au.
Welcome back, Phil Tarrant from Smart Property Investment, chatting with Eva Loenzons from Finny Mortgages, finny.com.au. These guys help people get out of mortgage prison. So what has changed, Eva?
So the big thing that happened end of last month is a few lenders, especially the majors at the moment, have decided that in some circumstances to refinance your mortgage, they won't apply 3% buffer, but only 1%. And that makes a huge difference into how much you can borrow, and if you can actually move from, let's say, CBA to NAB or CBA to St. George or vice versa. So it makes there's a lot of people out there that have been in that prison mortgage, unable to move, that might give it another go now, and it might actually work. So if you've been told no in the last 2 months before, let's say, July, it's worth revisiting your options.
Okay. And that's only for people who are refinancing their loan, not taking on new debt.
Yeah. So that is, I guess it's targeted more for owner-occupier people that have a mortgage, but it's actually also available for investments. People that have really clean repayment history for 12 months. Some bank actually ask also for a credit score of at least 650, which is not a huge score. It's just, good enough to be in the green. And basically, if you've had, a loan where it was fixed, or you were on principal and interest and you got interest only now, and you feel like, you could do better, you could get a better mortgage, it's worth visiting it now that buffer is at 1%. It could be a good $1,000 a month in assessment that you might recover from that.
So just quickly on, if you're coming off a fixed rate, which a lot of people are coming off a fixed rate, so you would just go on to the variable rate, which the bank provides. And if that happens, make sure you question it, because they'll probably put you on an inflated variable rate. You can call up and negotiate. Is any lender allowing you to come off a fixed rate straight into a, say if you're coming off a fixed P&I, are lenders, is it okay, or with the current lender, are they allowing you to go on to a variable rate interest only with the same lender without having to do another application?
No. Interest only is actually really hard to get after having paid P&I. You really need good reasons for it, especially if it's your home. So if you do want interest only, you would have technically to do a refinance, even if it's internal within your bank. And if you were in a mortgage jail anyway, it's likely that it's going to be even worse. So going to interest only is really hard. So most of the time you come out of fixed rate, you're going to be put on a variable rate. If you haven't negotiated with your bank or your broker, you're probably going to be on the basic variable rate, no discount. So you might end up actually on 8.5% before you finally realize, oh my God, what's going on? And you call the bank to get a discount on that.
Yeah, I had a situation in the Smart Property Investment portfolio recently with a major bank, and it come off fixed rate onto a variable rate, and they put me straight into 8-point-something%. Yeah. I called them up and said, "What are you doing?" Yeah. I went, "Oh, well, you should have called us." Like, the banks aren't going to do you, if you're coming off fixed rate, they're not going to do you any favors to put you on a competitive interest only rate. They're just not going to do it. They're going to put you right up there, and you're going to have to call them up. I was able to shave a couple of percentage points. I probably was maybe 2.5% off what they were charging coming off fixed to variable just by a phone call and being pretty angry about it. So again, banks aren't going to, I like banks, they're good, but they're not going to do you any favors.
Yeah, no, definitely. And that's unfortunately a very common story. So people need to be on top of it. And, it's a phone call that would save thousands a year. So make sure you make that phone call. And if it's not good enough, look at refinancing.
So how's this work then? So if you're coming off a fixed rate onto a variable rate, or you're not happy with your current variable rate, you want to move to another lender. Well, let's start with the former. You stay with the same bank that you have right now, and you get your re-index your ability to service at a different rate. How easy to do? Is a full application? Is everything right? Like, nothing really changes.
With your own bank, they should be able to apply a discount without reapplying for anything. That should be quite straightforward, unless, as you said before, you want interest only, which is then a full reassessment. So that should be quite easy, but it's likely they're not going to give you the most competitive rate, because they do know, the situation where people are stuck. Could be that you cross-collateralized as well, so you can't really move easily. Could be that they know your property hasn't really grown in the last year or two, so they know you will be over 80% LVR and you will have to pay LMI. So they sort of know when they don't have to make too much effort, and where they can keep you stuck there on a higher interest rate than you need to be. So it's really good to give it a second chance, I guess. Make a phone call to whoever it is, another bank, preferably a broker. So we've got access to a lot of lenders, and check your borrowing capacity on those new, it's called streamline refinance, simple refinance, alternative refinance. There's a lot of names for it, but it's a lower buffer that might give you access to a much, much better rate.
Okay. And if you're doing that, if you're refinancing your loan with a new lender with this view towards a 1% buffer rather than a 3% buffer, are they helping you out with any cashback offers or anything like that? There's none of that, right? I imagine it's pretty straightforward.
There's not many of those happening at the moment. But technically, if you think about it, if you're on 8.5% and you end up with a 6.5% rate on a 500K loan, that's a good cashback that's going to happen every month anyway.
Yeah, so you've got to look at what the outcome is rather than just some sort of headline, $1,500 cash back and all this sort of stuff. It pales in significance. So how are the banks able to do this, considering APRA have this 3% requirement? Have they given, because APRA must have confidence that we're towards the top end of the interest rate cycle, have they given permission for the banks to do this in certain circumstances?
Yeah, it's probably, and there's restriction to that. So it's not for everybody. If you've had any defaults in the past 12 months, it's not going to happen. Even if you have credit cards, car loan where there's been late payments or whatever it is, it's not going to happen. So it has to be a very, very green application, I guess, where everything is ticked, everything is looking great. You also will need to be on 80% LVR maximum. So it's quite, low risk for them. and you can only elect to pay principal and interest. So interest only isn't available for those type of refinance. So altogether, it's quite safe. It's quite easy for the bank to do it. There's not many risks involved. You can't really do cash out, can't really get anything out. So it's very much like I'm refinancing to get on a better rate, pay less, and that's it. And obviously with good history, the bank can see that it's low risk.
Okay, so it needs to be P&I. They're not doing it for interest only. For a lot of investors, interest only, they're still going to be assessed at that 3% buffer.
Yes, that's very much P&I. But if you've been on interest only for 5 years, you probably would be on P&I anyway in your current mortgage. So you might as well get one with a lower rate.
Yeah, and I reckon if you are coming off interest only onto P&I, do the math with your broker because, and I'm sure Eva and her team are happy to do this, because if you're coming off, say it's 8.5% down to 6.5%, you're going for interest only to P&I, whether that's happening or not, you'll probably find that the savings you get helps you still pay the principal off, and you're probably paying about the same amount of money. So you're getting a free pass on the principal. So it doesn't sound like this is for everyone, but it sounds as though, and I've spoke about it on this show before, this is where you're going to start to see innovation around the edges. I remember having a chat with Mark Burris from Yellow Brick Road around innovation in mortgages quite a few months ago. And we sort of spoke that this is where you'll start seeing innovation. My view, I remember a lot of investors haven't been investing that long, but I remember when you could just call up the bank when your loan was coming off interest only to P&I and just say, oh, please set it back to interest only. It was a phone call that you had to do, and it was just straight in. It was so easy. Now it's very, very difficult. That's interesting stuff. We're just going to go another break. Stay with us, everyone. Back in a moment. Welcome back, everyone. Having a chat with Eva Lowenzollens from Affinity Mortgages. Now, Eva, which banks are providing access to this new, I guess you call it incentive or a feature? Is it universal yet? Is a handful of banks doing it?
No. So it started last month with CBA, and then St. George came on board, Westpac, NAB. It's been Bankwest recently, and Nubank just last week. So it's not just the majors. More lenders are also coming on board with this. And as we go, we're probably going to see more flexibility around the product as well.
So flexibility means that there'll be other ways in which it could be more accommodating for more people over time, I would imagine.
Yeah. For example, St. George is already allowing $50,000 cash out, while other lenders wouldn't do that. So we see that each lender might have a little bit of advantage there, here and there. So it's going to probably get better and better as more come on board. And recently as well, FirstMac actually announced that they would drop their rates from 3% to 2% for any type of application. So refinance, investment, purchase, anything. And that really free up some servicing capacity for people looking to maybe not just refinance, but keep investing or buy more properties.
Yeah. And again, this is where you're going to start seeing innovation taking place. Once the market gets comfortable that it's at the top, and look, it's never a given that you're at the top of the interest rate cycle, but you'll start seeing a lot of innovation from the banks because the same premise applies. Lenders in the business of lending money, lenders make money for their shareholders through lending out money. They want to be lending out money to the right people in a prudent fashion. They have oversight with APRA that regulates a lot of that. So they all got to play within the rules as set by the government bureaucracy. But they're in the business of lending money, and they're in the business of getting money into the hands of owner-occupiers and property investors. And we only need to think about some of the challenges facing Australia now in terms of rising rents and access to housing and rental stock. Property investors play a key role. So if the banks are stifled from being able to lend money to investors, the inherent issue you have then is that there's less rental accommodation available for all Australians. And when you intersect that with growing inflation numbers, there's a lot of people who aren't going to have homes, and that causes a lot of problems. So it's a pretty complicated beast, but this is the way it all works. Eva, what should people do if people go, aha, I sound like one of them. I need to get myself out of mortgage prison with my current lender, my owner occupier, P&I, or if you are P&I on your property investments, there is a good chance you can get more favourable interest rates with another lender. How do you start that refinancing process?
Yeah, so the option would be if you haven't had your mortgage checked in the last month or so, to give us a call. You can put all your details into fini.com.au and we'll book an appointment to chat to one of our brokers, and then we can check if it's possible for you to refinance based on those new simple refinance options. Yeah.
So it's called simple refinance. So how long does it take? Like, how much info do you need in order to tee up a time to chat with someone? How long does it take to give you the information that you need in order to have a good phone call?
Look, it depends. If it's just somebody that has an unoccupied debt, just one mortgage, and they can give us, the income, assets, liabilities, we can tell them if it's working within 10 minutes.
Okay.
Right? If it's a more complex situation, obviously it might take a bit more time, but let's say within half an hour, there's a good idea. We have a good idea of what's possible or not. So
so put your details in affinity.com.au. Arrange a call with yourself and your team. And if it's simple, it's fast. I'm currently using Affinity to refinance a Smart Property Investment Show. And I'll tell you, I'm probably not one of those easy customers. Is it close? I'm a little bit more complicated. But for me, and it's a pain doing it. I don't have to do all the hard work. The Finny broker team are doing all the hard work, but I still need to give all the inputs. That takes time, energy, and effort. However, when I look at it at P&L balance sheet level, P&L and a balance sheet level, way ahead of the game. So a bit of pain at the front end to actually get my mortgages I'm going through. And I'll start talking about it a lot more now that we're quite far through the process. I think we've selected the lenders that we're using for the Smart Property Investment portfolio. We're well underway, so I can start chatting about that very shortly. But moving from P&I to interest only will save a considerable amount of money and getting more preferential rates. So I'm really excited about doing that. But get in touch with Eva and her team, finny.com.au. They can help you out. If you want to get out of mortgage prison, there is a way. Even if you if you think you're at the end of it and there's no alternative available for you, it's always good to get a second set of eyes over it. Eva, thanks for your time.
Thank you. Thanks.
Nice one. Thanks for tuning in, everyone. Remember to smartpropertyinvestment.com.au. We're chatting a lot about this right now, trying to raise awareness that there is opportunities and alternatives for most borrowers. Don't feel as though you're stuck. Keep pushing, keep exploring, be curious, because there's probably a way. And I can probably guarantee that a mortgage broker is going to get you a better outcome than a bank when it comes to this, because banks, if you're with them right now and you don't use a mortgage broker, it's not part of their business model to make it difficult, but they're not going to do you any favors. It's a nice way for me to explain that. That said, thanks, banks, for lending money. It makes us better property investors as a result of it. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.